Zoom kai magana mai zuwa.
Any program
Maybe, but no way that if I found any perform. Was I never for long back.
àwọn èèyàn tó lè join ẹ máa kọ́ tẹ ẹ máa yà fún minimum èèyàn tó lè join ó ti pé bá tí wàá fi lè close eléyìí yóò jẹ́ nìkan wọlé ẹ̀yìn òní ráyè wọlé.
Hello, good afternoon, everybody. My name is Hallelujah Edem. I'm the chairperson of the MBA YLF Continuing Legal Education Committee, the convener of this webinar. The MBA YLF Continuing Legal Education Committee, the convener of this webinar. We're currently having some difficulties.
Good afternoon, everybody.
We're currently having a little difficulties.
Good afternoon, everybody.
Bringing on the speakers.
Good afternoon, everybody.
We really appreciate it if everybody mutes themselves to avoid interferences. We really appreciate it if everybody mutes themselves to avoid interferences. And we'll start shortly. We appreciate it if everybody mutes themselves to avoid interferences. And we'll start shortly. We appreciate it if everybody mutes themselves to avoid
dole zai yi da sa rai misali a cikin da take zuwa cikin operation amma dole na ga kuma aiki ya kamata na ba ku wanda ba ga ba nan amma idan huce na sun ya dan huce gaskiya akwai mara sanya wani yawa bar yan ajin kuma ta ajin wanda zo inda yan Kano ne wanda zo da kana yanzu ko duk batun ba da grade din da ake da ta kare a ta kare na
Ibrahim, can you mute your speaker, please? Thank you.
zai ba bai kuna sai amma bayan an gama wallahi ina jira maka amma wallahi bai wa Allah amin ita ba wani dinda ko free
Most of them they normally
mute the speaker. Kamata a ce ana ci da dai chatting ana gani.
They are around, but they just stepped out, not quite long. Okay. 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 All right. Thank you. Okay. In the course of business,
Hold on, please. I'm under so much stress. I can't. Hold on, please. I'm under so much stress. I can't.
I think it might make more sense to close the entire session so that you have your speakers on ground, then restart it again. So everybody joins once again.
Okay, we're not hearing anything here.
Well, good afternoon. If you log everybody out, you have difficulties in logging in. That is how Zoom work. Let's just mute our speakers, mute our video, let the host rectify everything.
If anyone is, kind of feeling tired of waiting, there is a leave button up there. You can click on leave and then read. The organizers are still trying to come up with the speaker, so let's just be patient. Thank you.
Apart from that, they should be able to control the mute from their own end.
Yeah, they are doing that. They are trying to control the mute from their own end.
Oh my God. My God.
Ti jáde. Jáde.
Okay, good afternoon, everybody. I really apologize for the delay in starting. The logistics of everybody joining was a little difficult. Really apologize for the delay in starting. The logistics of everybody joining was a little difficult. Really apologize for the delay. Okay, I would like to retrace that everyone mutes their mic so that we can proceed without issues. Good afternoon again, everyone. Welcome. Okay, I would like to retrace that everyone mutes their mic so that we can proceed without issues. Good afternoon again, everyone. Welcome. Okay, I would like to retrace that everyone mutes their mic so that we can proceed without. Why is it on one device? Why is it doing? Seems as though I'm apologizing non-stop. We just didn't expect such a turnout, rather. I'm very excited to have everyone here. Seems as though I'm apologizing non-stop. We just didn't expect such a turnout, rather.
We're waiting already.
To have everyone here. Seems as though I'm apologizing non-stop. Just didn't expect such a turnout, rather.
We're waiting already.
To have everyone here. Seems as though I'm apologizing. Please, can everybody mute their mic so that we can solve this echoing issue? Please. Everybody's hearing everything. Can everybody mute their mic so that we can solve this echoing issue? Everybody's hearing everything. Can everybody mute? I guess we'll go ahead like that. My name is Hallelujah Edem, chairperson of the Continuing Legal Education Committee of the MBA Young Lawyers Forum. We are very grateful. I guess we'll go ahead like that. My name is Hallelujah Edem, chairperson of the Continuing Legal Education Committee of the MBA Young Lawyers Forum. We are very grateful to the Institute of Continuing Legal Education for supporting today's session as part of its mission to promote continuous professional development. To the Institute of Continuing Legal Education for supporting today's session as part of its mission to promote continuous professional development. As an affiliate of the Young Lawyers Forum, our goal is to give young practitioners the tools they need to excel. And today's topic is a perfect example. An affiliate of the Young Lawyers Forum, our goal is to give young practitioners the tools they need to excel. And today's topic is a perfect example. An affiliate of the Young Lawyers Forum, our goal is to give young practitioners the tools they need to excel. And today's topic is a perfect example. An affiliate of the Young Lawyers Forum, our goal is to give young practitioners the tools they need to excel. And today's topic is a perfect example. An affiliate of the Young Lawyers Forum. So on 26, 2025, President Tinubu signed 4 new tax laws into effect. So on 26, 2025, President Tinubu signed 4 new tax laws into effect. So on 26, 2025, President Tinubu signed 4 new tax laws into effect. The Nigerian Tax Act, the Nigerian Tax Administration Act, the Nigerian Revenue Service Act, the Joint Revenue Board Act. Together, these acts completely reshape our tax system to make it simpler, fairer, and more in line with international practices. The Joint Revenue Board Act.
Hello?
These acts
Hello?
completely reshape the system to make it simpler, fairer.
Hello, the organizer.
I
I suggest that you end the webinar and let everybody log in so that you'll be able to sort yourself out.
Hi everyone. Good afternoon. I think I have to apologize at this point on behalf of the MBA YLFCLE. We've had to experience some sort of technical glitch. So I know that this wasn't really planned. I guess we have the numbers of people who sort of had what we had projected for, but we'll soon start. Our first speaker is already on the call. So maybe if you just allow us for a few seconds, we'll quickly just introduce the speaker and allow him to begin the webinar itself proper. So again, on behalf of everyone, all the planning committee, the MBA, YLFCLE, we sincerely apologize for the delay. We've taken about 37 minutes, but we'll be starting right away. So sincere apologies once again. Yeah, so just give us a few seconds. We'll begin the introduction and then commence immediately. Sincere apologies. Okay, so very quickly, our first speaker is Kelechi Ibe. Kelechi Ibe is a seasoned corporate and tax lawyer with over 8 years of experience. His expertise encompasses taxation, M&A, finance, and general corporate advisory. He has played a vital role in advising on high-profile transactions within both Nigeria and international markets. Presently, Kelechi serves as a senior associate at Vildodo and Bello Sage. His prior experience include working in the deal advisory and M&A tax unit of KPMG. He also completed a distinguished secondment at Latham and Watkins in London through the International Lawyers for Africa flagship secondment program. Kelechi is actively involved in the legal community as the secretary of the Taxation Committee of the Nigerian Bar Association section of business law. He's also an associate of the Chartered Institute of Taxation of Nigeria and a student member of the Association of Chartered Certified Accountants. His contributions to the legal profession has earned him several accolades. He was a nominee for the Future Awards Africa Prize for Lawyers, an award recognized by Forbes as Nigeria's most important youth award, and by the World Bank as the Nobel Prize for Young Africans. Kelechi is also ranked as a rising star in the general corporate tax and transfer pricing by World Tax International Tax Review. His exemplary career was further acknowledged when he received the Lawyer of the Year award at the 2022 CEO's Network Africa Awards. In addition to his professional accomplishment, Kelechi co-founded the Greenwich Foundation, Africa's pioneer technology-focused non-profit. The foundation leverages technology to connect small businesses as well as business owners with corporate law firms, providing pro bono corporate legal services to help these businesses thrive and continue to serve as economic catalysts in emerging economies like Nigeria. Without so much, I'd like to quickly introduce our first speaker for today, Mr. Kelechi Ibe. You're welcome, sir. Please, sir, if you're on the call, could you kindly unmute and possibly allow us to see your face as well? Thank you so much.
Thank you, Medion. Hi, everyone. Can you hear me, Medion?
Yes, I confirm I can hear you. Sincere apologies, Mr. Kelechi, that we had to keep you I think 40 minutes now. Honestly, we had envisaged some of these technical issues, but it really wanted to go out on a board. Hopefully, we've been able to control that. So thank you again for the patience and welcome to today's event.
It's okay, no worries at all. I'm happy that I'm able to make it to the session. So, again, good afternoon, colleagues. So my name is Kelechi Ibe. Please, can I please request that everyone turn their microphones off, just so that we don't have any interference, and so you can hear me. And also, please, can you confirm?
Yes, I can see your screen from my end. And maybe just to repeat the ground rules again for everyone, I'm sure earlier speakers had mentioned this. Would like that all attendees mute their microphones as we proceed with the presentation. Maybe to also note that this event is currently being live streamed, so we have numerous attendees across the country attending as well via YouTube. So please advise all participants who are joining on Zoom to kindly mute their microphone throughout the duration of the event. Thank you. And please also to note as well, we will take questions after the last speaker has spoken. So kindly drop your questions at the Q&A box and we will take it accordingly. Thank you so much. Over to you, Mr. Kelechi.
Okay, I'm back now. Sorry, I had to fix my network issues. Can you hear me?
Yes, I confirm I can hear you.
Awesome. Okay. And you can still see my screen.
Yes, super. I can.
Okay, great. So, okay, I think I'll just leave my video turned up for now, just so I can help my bandwidth. Okay, so today I'll be attempting to explain to us some of the changes that have been introduced into the Nigeria's tax landscape by the Nigerian Nigeria Tax Act 2025. Like Hallelujah said when she started, the Nigerian president had signed into law several tax bills, one of which is the Nigeria Tax Act 2025. And the Tax Act attempts to, or what it does, as we would see in the presentation, is that it harmonizes, it repeals several existing tax laws and consolidates into a single legal framework different laws that govern taxation, and now has a single document that imposes taxes. So before now, we used to have the Companies Income Tax Act, we used to have the Petroleum Profit Tax Act, we used to have the Capital Gains Tax Act, the Personal Income Tax Act. So there were different tax laws, Value Added Tax Act and the likes, Stamp Duties Act and all of that. These were all in different legislations, and it was really complicated and difficult to understand. So please can we stay muted? So what the Nigeria Tax Act, I will just call it the NTA. What the NTA has done is to consolidate these different taxes into one tax. And again, it also streamlines, so because it has consolidated the tax laws, it has also streamlined the number of taxes into a manageable tax unit. So, and I'll show that to us. Also, what the NTA has done is to eliminate something we call nuisance taxes that used to yield very minimal revenue. And then again, so for instance, we used to have companies. I'll give you context. So companies used to pay companies income tax, and then in addition to companies income tax, they'll pay tertiary education tax. In addition to that, some companies will pay something called the NIDA levy, National Information Technology Development Agency levy. Again, they also pay something called the NASENI levy. And also there's another tax called the Nigeria Police Trust Fund levy. And so these are just different taxes that companies had to pay, and it was really difficult to manage all of that. But what the law has now done is it has harmonized all of this into one legislation and into basically two broad taxes or three broad taxes. So you don't have to deal with many taxes pretty much. And the idea is to make it easy to administer and also to minimize the cost of compliance as well. So, I mean, I will share my slide eventually, but I'll try not to take too much because we've already spent a lot of time on the call. So I've already explained most of this. Before the NTA, we used to have somewhere around 14 to 15 different tax legislations. different laws that had tax clauses. So we used to have core tax legislations, and then we had legislation that were not core tax but had tax clauses in them. But now everything has now been consolidated into one. And so I'll attempt to explain some of the new changes that have been introduced by the Nigeria Tax Act. One of those changes now, so there's been like an expansion of the tax base. We now have clarity around what kinds of income is taxable and what's not taxable. So we have, so it's now clearer that prizes, all these prizes, winnings, honoraria, grant awards, and gains from digital and virtual assets are now taxable. So people who used to earn, all these people who used to do like Big Brother Nigeria or Nigeria Idol or all of those things, those monies they win from those shows, those prizes are now liable to tax. So it's clearer now that they're taxable. Before it wasn't clear, and so people didn't need to pay taxes. Also, the definition of interest. So we all know what interest is. Interest is payments, an extra payment that you make on a loan, right? That's the very simplistic way of explaining what interest is, an extra charge that you pay when you borrow money. But the law has now expanded the definition of interest to include penal interest. So that's if you're paying interest as a penalty. So like under the tax laws today, if you owe taxes and you do not pay your taxes on time, when you're computing your tax liability, when the tax authorities rather are computing your tax liability, they would also add interest and penalty to it. So penalties and interest rather. So the penalty usually is 10%, and then interest would usually be around, would follow the CBN monetary policy rate, which is currently 27.5%. So that interest you pay on the tax you owe is also counted as expanded, is also added as the definition of interest pretty much. Also, foreign exchange differences that relate to securities and payment that relate to derivatives have now been expanded, have now been added to the definition of interest as well. So this means that any earnings that you make from any of these activities, whether it is interest you earn from money you lend or interest you earn as penalty. So we used to have, there are some clauses in some loan agreements that say when you borrow money, you have to pay back at a particular time. If you do not pay back at that time, you would be incurring an extra interest on top of the original interest. So that's like a penal interest. Or you would find some engagement letters. So even some lawyers do it where they provide services to a client and they issue an engagement letter and they say, our invoice is due within 30 days of issuing the invoice. If after 30 days you do not pay the invoice, we have the right to charge an interest of maybe 10% per annum on any unpaid fees. So that extra interest you're charging is like a penal interest. It's an income that's taxable. So that's pretty much what the law has done. It has expanded it to include those. Also, the definition of dividend has also been expanded. Before now, dividend just used to be payment, whether in cash or through bonus shares that companies get, or that persons get rather in a company, representing their interest in the company. But now the definition has been expanded to include any other distribution of a capital nature, which was previously excluded under the CETA. It is now added as dividend. So I'm thinking of what possible example to give as a distribution of a capital nature. So, well, I guess maybe return of capital to a company where there's been a profit. So where you're getting an increased return on your capital, it's now counted as a dividend. Even if you don't call it a dividend, as long as you're getting any kind of distribution from the company, it's now categorized as a dividend and liable to payment. So maybe distributions from capital gains tax. Maybe company has made capital gains tax. A company you've invested in has made a capital gain, and they're distributing that capital gain to the investors as dividend. that is also going to be classified as dividend and taxable. Before, it wasn't the case. Every capital transaction wasn't taxable under the Companies Income Tax Act. It was only dealt with in the CGT, under the CGT, Capital Gains Tax Act rather. But now we'll be liable to tax. So because of time, I would like to move really quickly. In terms of corporate taxation, so the new rules we've seen now is that Nigeria has introduced something called rules for taxation of controlled foreign corporations. It's a new rule. Nigeria didn't have CFC rules. But what that means is if you're a Nigerian company, I'll use like maybe GT Bank, for instance, or Access Bank that has branches outside of Nigeria. If you're a Nigerian company and you have subsidiaries, foreign subsidiaries, you would be required to account for the profit of those subsidiaries. So a situation where, and let me try, because I think for me, to break things down for us, considering that we are not, a lot of people on the call are not tax lawyers, so I'm trying to be as simplistic as possible. I would like to break it down as I'll make it as granular as possible within the short time that I have. But think about it like this. When you invest in a company, when one company sets up a subsidiary, the income that the parent company, so the company that sets up a subsidiary is like a parent company, the income that the parent company earns from that subsidiary would usually come in form of distributions, in terms of dividend distributions. Now, if a Nigerian company sets up a foreign subsidiary, the expectation is that if that foreign subsidiary makes money, it would remit a part of that money to the Nigerian parent company in form of dividends. But there have been some tax planning strategies where the Nigerian parent company will not bring in the money into Nigeria. They would rather not declare, the foreign subsidiary would rather not declare dividend, so that the money doesn't come into Nigeria and it's not taxed. They keep the money offshore. So what the tax laws now do, or what the tax laws have now done, or the NTA has now done, is that if the foreign company, the foreign subsidiary has made profits, and that foreign subsidiary can actually distribute the profits to its Nigerian parent company in form of dividend, but it refuses to do so, the Nigerian tax authorities have the right to deem the profits as distributed and tax it in Nigeria accordingly. So that's another innovation that has been introduced. So it's something you need, your clients need to be aware of in case you're advising them. Also, Nigeria has introduced into its local laws something called an effective tax rate, a minimum effective tax rate, which is one of the proposals by the OECD, which is that multinational companies that do business in Nigeria must pay a minimum of 15% of their profits generated from Nigeria. So in our laws now, that has been codified to apply to foreign companies. So foreign companies doing business in Nigeria are no longer able to avoid paying taxes. They have to pay at least 15% of their profits from Nigeria in taxes. Then we all know that the Finance Act 2019 has also limited the scope, the taxation of small companies. So before now, if you were a small company, and a small company used to be a company that had less than 25 million naira in total revenue in a given year. If you were a small company, you were exempted from taxes. But now, the threshold for small companies has been increased from 25 million to 100 million. So as a company in Nigeria, if you make less than 100 million in a year, you do not have to pay taxes in Nigeria. You will not have to pay companies income tax or corporate tax in Nigeria. You are more or less exempted from companies income tax if you make less than 100 million in a given year. Then if you make more than 100 million, you'll be taxed at 30%. We are not sure of the rate, and I think it's at this point I should make it very clear that we do not have the final version of the law yet. So most of the things that you've seen in this slide are contained in different versions of the law that have made their way to the public. Some are in the tax bill, some in the new tax law. We haven't seen the signed version, the version that the president signed And even if you had the signed version, we need to wait for the gazetted version, and that is not yet publicly available. So what I'm going to tell you on the call today might change, but not significantly. So just for your benefit. So that's one key takeaway. Also, another key takeaway that I need to mention is that I'm trying to make this sound very simple as much as possible, but when a foreign company does business in Nigeria, they create something called a permanent establishment. I'll use an example of Zoom, maybe Zoom or Netflix. If Zoom, a lot of Nigerians use Zoom, they subscribe, they pay Zoom, but Zoom is not physically in Nigeria, but they're earning revenue from Nigeria because Nigerians are subscribing to use the platform. Now, Zoom is required to pay tax in Nigeria based on our local laws, but in terms of determining what tax Zoom should pay, it's been difficult to determine that. And the reason is that you pay tax on profit, not on revenue. And we all know what profit is. Profit is your revenue less your expenses, your allowable expenses. And then you only pay tax on what is your profit. But how does a company like Zoom or Netflix determine its expenses in Nigeria? Because it doesn't have an office in Nigeria, it doesn't have employees in Nigeria, it doesn't incur advertising costs in Nigeria. So there are a lot of difficulties in determining what its profit is in Nigeria. So what the law has now done is the NTA has now devised a means to say where it is difficult to ascertain the tax that should be paid by a foreign company in Nigeria, they should pay at least 4% of the revenue they've generated in Nigeria. All the total income generated, they should pay at least 4% of that amount as tax. That is the minimum tax that they'll be required to pay. And that's sort of like an innovation to make it clearer. I mean, it sort of tries to codify what was already existing. We used to have like a deemed profit margin of 20% for foreign companies, which when you then apply the 30% tax rate, it gives an effective tax rate of 6%. But the law has now reduced that effective tax rate to 4% for foreign companies. Okay, moving on. Another innovation we've noticed is something called a change to the rent test. Before now, or under the current law, and just to mention that the Nigerian Tax Act and every other tax reform act will take effect from the 1st of January 2026. So for now, we are still under the current regime, even though the laws have been repealed, but the new laws will take effect from next year. So the current Companies Income Tax Act, Personal Income Tax, and all of the tax laws we have are still in operation today, but that will change from the 1st of January. So as of today, we have something called the rent test. So when you want to determine what expenses a company can deduct from its revenue, the law says that the expenses that they would allow you to deduct are expenses that are wholly, reasonably, exclusively, and necessarily incurred in generating your profit. So it means that if you did not incur that expense in generating your profit, you cannot deduct it. That's the rule. So, for instance, you cannot deduct school fees, a director's school fee or a shareholder school fee from the profits, from a revenue of a company to determine the profit, because that school fee for the children or the director's children is not a cost that is wholly, exclusively, reasonably, and necessarily incurred in generating profit. So, but then the law now, the NTA has deleted reasonable and necessarily. So the expenses that a company can deduct from revenue are expenses that are wholly and exclusively, incurred in generating profit. This means that the tax authorities it has to be objective. So because reasonable and necessary were subjective. If I pay, let me give you an example. If I am a bank and I pay external security people to move money with my bullion van from the central bank to my office, you could say that that expense is reasonable, but the tax authorities can come and tell you, no, that is not reasonable, that you're supposed to use the police or the DSS to move money. For you to have procured the services of a private security agency was not reasonable. So reasonable and necessary used to be very subjective, and it used to drop a lot of issues during audit. So now there will be no need to evaluate any subjectivity. It's going to be clear. The tax authorities will only look at this expense you want to deduct. Was it incurred for this business, and if they can make that determination, they will allow you to make the deduction. Another thing that has changed in the law is we all know that free zone entities are exempted from tax in Nigeria, but they pay their own levies or fees in the free trade zone. But from the 1st of January 2028, there's a proposal now to tax free zone entities fully, as long as they are doing what. So currently, for you to qualify for the exemption as a free zone entity, you must sell at least 75% of your products in the free zone. Only 25% can be sold in customs territory. If you sell more than 25% in customs territory, you are no longer a free zone entity. You pay taxes to the FIRS. But from the 1st of January 2028, free zone entities will now be taxed fully. At least that's the proposal that we know, regardless of the threshold. So even if you sell 100% of your products in the customs territory, you still pay taxes in Nigeria. That's what's being proposed now, and we don't know what the final thing would look like, but that's part of the proposals. So I'll move away from companies taxation. I'll speak now to individual taxation. That's personal income tax. There's now like an exemption for people that earn the minimum wage. So if you earn 800,000 naira in a year, in an entire year, I think that comes down to I think 66,000 thereabouts in a month. Let's say 67,000. If you earn about 67,000 naira in a month, and you earn about 800,000 in a year, you will not pay any income tax, personal income tax in Nigeria. But once you start to earn more than 800,000 in a year, you start to pay taxes. Now, the tax rate, Nigeria operates something called a progressive tax rate. Before, the tax rate used to start from 7%, 11%, 15%, 21%, and then 24% was the marginal rate. But now it has changed. The tax rate now is the first 2.2 million will be taxed at 15%, and then it graduates like that. The next one is the next 10 million is taxed at, I think, 18%. The next 13 million is taxed at about 21%. And then there's 23% and then 25%. So effectively, individuals will pay more taxes. Personal income tax will increase for everyone that earns above the minimum wage or above 800,000. And this is more so because the law has eliminated something that used to be called the consolidated relief allowance, which was a relief of about 21%. It used to be 20% plus 1%. That's about 21%. So there used to be a bulk relief. So to determine your tax base, you could just deduct 21% from your gross and then deduct all your allowable deductions like your pension contribution, your insurance, and all of that before arriving at your tax payable. But now they've deleted that and they have replaced the CRA with something called a rent relief of 20%. So they replaced the CRA, which used to be 21%, and now gave us a 20% rent relief. But the problem is that they've now capped the rent relief to 500,000, which is very unreasonable. So it means that if your rent is more than 500,000, you can only claim 500,000 as a relief. And it means you're exposed to much more individual taxation than before, which is a big problem for earners, income earners. And then the condition to even claim this rent relief is that you must declare how much you actually pay as rent. and the tax authorities have the right to request additional information to ascertain what you pay as rent. And individuals who live in their own house cannot claim this rent relief. So if you own your house and you're not paying tax and you're not paying rent, you cannot claim this relief. So I guess some people will have to start thinking of how to own their houses with the company and pay rent to their company. You know, there are a lot of, I think there can be some structures you can create to minimize your tax exposure, but this is going to create opportunities for tax lawyers to also structure around. I'm almost rounding up in my presentation. I don't know how many more minutes I have, but I will now speak about capital gains tax. So capital gains tax is the tax you pay when you make a gain on the disposal of assets. So you buy a land, 2 million naira, and you sell the land for 10 million. You made a gain of 8 million. If you take out other deductions like incidental cost of selling, lawyers' fees, accountant fees, surveyor fees, and all of that, let's say you make a gain of 5 million. It used to be that you would pay capital gains tax at 10% of 5 million, and that's 500,000. That was your capital gains tax. But now the law has changed. It has changed. So you no longer have capital gains tax as a standalone tax. Capital gains tax has now been merged with companies' income tax. So what it means is companies will no longer be paying 10% capital gains on any gain they make from selling assets. They will be paying the company's income tax rate. So what the law is now saying is, as a company, you will report your income from your trading activity. Let's say you are a distributor of Indomie. So you noodles, you buy noodles and you distribute, and you make your revenue from selling noodles. And when you also own a warehouse somewhere in, let's say, Apapa, the law now is that you report your revenue from selling noodles, and then that land, that warehouse in Apapa that you sold, the gain you made from that warehouse in Apapa, you add it to your regular revenue as a company, and then pay your company's income tax on that. So that means that the rate has increased, because don't forget, the company's income tax rate is currently 30%, while the capital gains tax rate is 10%. So it means that we've moved away from a regime where you could pay 10% on capital gains tax to a regime where you will now pay 30% on capital gains, which increases, the costs significantly for individuals and businesses. And chargeable gains now include shares, foreign currency, digital assets like cryptocurrency and the likes. Now, but there's an exemption for shares. If you own shares in a company and you sell your shares for less than 150 million and you made a gain of less than 10 million, you will not pay capital gains tax. You won't pay gains. You won't pay tax on the gains you made from the sale of the shares. So some of you that bought GT Bank shares, I heard GT Bank has really appreciated. People who bought the shares bought at 44 naira. As of yesterday, the shares was like 103 naira. They've made about 59 naira per share. They've made a gain. Normally, that gain should be taxable, but if you don't make up to 100 million currently, or under the new law, if you don't make up to 150 million from the sale of the shares and your gain is not more than 10 million, you will not be required to pay any tax. Also, if you reinvest the proceeds into the buying shares in another Nigerian company, you will not be required to pay taxes. And that's when I say taxes, I mean like tax on the gain. Another very innovative provision of the NTA is the taxation of indirect disposal of shares. Now, for you to pay under the current regime, you pay tax on the income, on the gains you make when you sell your shares in a Nigerian company. So if I, Kelechi, own shares in, let's use Access Bank, I will only be required to pay tax if I sell my shares in Access Bank and I make a gain from selling my shares in Access Bank. But imagine a scenario where I, Kelechi, I went to Mauritius, I set up a company in Mauritius, and then the Mauritius company now bought the shares. So instead of buying the shares directly in Access Bank, I registered a company in Mauritius, and then I capitalized that company, I funded the company, and the company then used that money to buy the shares in Access Bank in Nigeria. Now, when I want to sell the shares, instead of the Mauritius company selling the shares, don't forget I control the Mauritius company. Instead of the Mauritius company selling the Access Bank shares to a buyer, rather than do that, Kelechi, I now sell my shares in the Mauritius company to a third party. So what that does is, I haven't sold my shares in the Nigerian company. Don't forget, I own my shares in the Nigerian company indirectly through the Mauritian entity. And when I want to sell those shares, rather than sell the shares in the Nigerian company, I sell the Mauritian company shares, the Mauritius company shares to a buyer. So what that now does is that the buyer now owns the Mauritius company, which owns the Nigerian company, the shares in Access Bank. So effectively, the buyer still owns the Nigerian company shares, that's the Access Bank shares. The law now is that even though I did this transaction offshore, I sold my shares in Mauritius, not in Nigeria, as long as the shares, the Mauritius company derives over 50% of its value from holding Nigerian company shares or holding an asset in Nigeria, that transaction, even though it happened offshore, will be taxed in Nigeria. So it's called the taxation of indirect disposal of shares. And there are some conditions. So this helps us to realize that the loopholes for tax planning is closing. So if you used to advise clients to buy assets or shares in a Nigerian company through offshore vehicles, that may no longer be tenable. So I'll wrap up now. All right, I'll wrap up now. Another very important point to make is that the law has introduced some. So remember, I said they have repealed a lot of laws and a lot of taxes have been repealed and now consolidated into one tax. So every company in Nigeria will be required to pay something called a development levy of 4%, 4% of their accessible profits. But this excludes small companies, non-resident persons, non-resident companies, and hydrocarbon tax profits. So this new levy has replaced the tertiary education tax, the NIDA levy, the NASENI levy, which used to be different levies that were paid into different funds. And it has also broadened the tax net. So before now, only specific companies used to pay NIDA levy and NASENI, like oil and gas companies, banks, insurance companies, pension funds, and all of that. But now every Nigerian company, apart from small companies, will be required to pay this development levy at 4%. So more income for the government, really. Finally, I'll just wrap up here. We used to have something called the pioneer status incentive that used to exempt specific companies from tax in Nigeria for 5 years. Now that has been replaced with something called economic development incentive, which gives a tax credit. So it has repealed the outright exemption from tax and has replaced it with a tax credit. Because of the want of time, I'm very happy to share my slides. But one very important thing to mention is that before now, if you were a Nigerian person and you earned foreign income, let's say dividend from a foreign company, rent from a foreign company, interest from a foreign entity, and you brought all of that income into Nigeria through your domiciliary account, you were not required to pay any tax. It was tax-free, it was exempted from tax. But the law has changed now. So that's tax-free, income no longer applies. So if you earn interest, dividends, any kind of fees from outside of Nigeria, you're still required to now pay tax in Nigeria. I think that the rest of the slides are self-explanatory, but one important point I want to make about stamp duties is that the law has now clarified who should pay stamp duties. So before now, under the current Stamp Duties Act, it wasn't very clear for some kinds of transactions who had the responsibility for stamp duties. But the law now has clarified for each transaction, it has stated which party has stamp duties obligation. And for share transfer, when you're doing a share transfer agreement, a share purchase agreement, there used to be argument about whether it was exempted from tax or whether it was only the share transfer forms that were exempted. Now, share transfer documents have been deleted entirely from the Stamp Duties Act. So if you do a share deal, all the documents prepared for that transaction, both the share transfer form and the share purchase agreement, will be liable to stamp duties, except where the transaction value is less than 10 million, or if the transaction, the transfer of shares is between related parties that have been related for some time. So I think at this point, I would end my presentation. Like I said, I'm happy to share my slides. And if anyone has any question, I'm happy to take. You can. I don't know if I can take any questions right now because of the want of time, but I'm happy for you to share your questions with the administrators. I'll be more than happy to share, to give the answers. Thank you. Thanks for having me.
All right. Thank you very much, Mr. Kelechi, for such an insightful presentation. Like you've indicated, if anyone has questions, we'll be happy to, share that with Mr. Kelechi just after our last speaker presents. So thank you very much, sir. It's really insightful. And maybe just to also notify all our participants, we will be sharing the slides after the event. So we'll be sending it across via emails to all participants. So also maybe to also note, because I've seen emails dropping in from participants in relation to CPD point. So we at the end of the event, we'll be sharing a link which you can simply click on to get the CPD point. So you don't need to share your emails and your Supreme Court number, right? At the end of the event, we will share a link that you can simply click on. For those attending via YouTube as well, we would also drop via the chat session the link just so they can as well click on the link to get their CPD point. So it's really needless to share your name and your Supreme Court number. So thank you again very much, Mr. Kelechi. Thank you so much. I would just proceed because of time. And again, we have a hard stop, just so we don't keep all our speakers waiting. So we'll quickly just jump into the next speaker. And I know that Hallelujah would be gracious to do the introductions of our next speaker, so we can proceed from there. Thank you so much, Mr. Kelechi again. Okay, I don't know if the admin can help unmute Hallelujah. She's trying to speak. I think she's having a bit of constraint with that. All right.
So thank you very much once again, Mr. Kelechi, for such insightful presentation. Just to save time, we'll just dive right into the next session for the next speaker. We have the honor of having Mr. Olamide Obajimi on our panel to discuss the Nigerian Tax Administration Act. Mr. Olamide Obajimi is a partner in Olaniwajaye LP, particularly in the firm's tax practice group, with extensive experience in corporate tax structuring, compliance, cross-border taxation, transfer pricing, and tax litigation. He's a chartered accountant and a lawyer. He has advised several clients across sectors on tax audits, investigations, and regulatory matters. He's also a fellow at the Institute of Chartered Accountants of Nigeria, that is ICANN, and has an advanced diploma in international tax issued by the Chartered Institute of Taxation. As a testament to his wealth of experience, he was recently inaugurated as the chairman of the Tax Appeal Tribunal, Lagos Zone. Please welcome Mr. Olamide Obajimi. Round of applause. I yield the floor.
Okay, good afternoon. Can everyone hear me?
Yes, loud and clear, sir. I can hear you loud and clear.
Okay, great. So I won't waste much time. I think Kelechi has done justice to the Nigerian Tax Act. And I think by way of introduction, it's important to let us know that before the tax reform activities took place, issues around administration of taxes were in the respective tax laws. So, for example, we had the Company Income Tax Act. There's a part in the Company Income Tax Act that talks about administration of that tax. Also in the Personal Income Tax Act, the Petroleum Profit Tax Act, all these various laws have the administration of their taxes in the law as it were. But one of the good innovation that the tax reform activities did was to have a separate legislation for tax administration, whilst all the relevant laws were consolidated into one document that we now know as the Nigerian Tax Act. Okay, I think it's no longer news that the president had signed these legislations. However, we are yet to get the gazetted copies. What we see flying around in the public space is the last harmonized version that was cited. So whatever it is now, it is not yet the gazetted copies, and we must give that caveat. And one great thing that these tax laws, new tax laws, try to do is just to make the laws as simple as it will be. For the student of taxation, we understand that one of the great canon of taxation is simplicity, ability to understand the tax laws with ease, and I think these new tax laws, have been able to do just that. Okay, so what is the Nigerian Tax Administration Act all about? Well, as it is, it's tend to provide uniform procedures that are consistent across board for all the relevant tax heads, meaning that where there are failures to comply, one tax law is not greater than the other. What you have is that the penalties for non-compliance, the procedures for compliance, have all been harmonized in this law, and it makes it, simple for taxpayers to follow. And when you look at it, that when tax laws are easy to follow, it will ensure compliance by taxpayers, and compliance is the key for every tax administration system. And we've tried to break some of these things down. If you look at these new laws, it has about, especially this Tax Administration Act, has 4 chapters. And these 4 chapters, are divided into part 1 that talks about objective, part 2 that talks about returns, assessment, payment, and enforcement. The 3rd part talks about general tax administrative provisions, while the last part talks about offenses and penalty. Because of time, we've just been able to streamline some of those changes, highlight the key ones so that we can, this will aid, our further reading and understanding of these provisions. The first I have on my slide is delegation of tax administration. Before now, what we had was that there was the Personal Income Tax Act, the Company Income Tax Act, the Petroleum Profit Tax Act, and each of these acts are administered by different regulatory authorities. For example, when it comes to corporate taxes, we have the FIRS. When it comes to personal income taxes, although the federal make laws, that the collection is being administered by the state. So imagine the Lagos State IRS decide to conduct an audit on XYZ Limited, And in the course of conducting that audit, they realized that about 10 employees in XYZ Limited are residents in Ogun State. Ordinarily, Lagos State will just ignore those ones, do their computation and move on. Now, with this provision, Lagos State can easily inform Ogun State that Ogun State, there are companies I'm auditing in Lagos. I noticed your staffs are there. I'm going to help you in relation to the tax audit, and I will, compute the relevant tax on their behalf. In this situation, the tax authority in Ogun State is giving part of its powers to the tax authority in Lagos State for the purpose of collaboration. And this is one thing that this tax reform has been able to do, to ensure that there are increased collaborations between relevant tax authorities, such that tax leakage is going to be reduced drastically. Also, the FRS can be conducting audit on a company, and you see staff cost in a particular company. Let's say staff cost is 1 billion. The FRS can say, let me see your receipt showing compliance in relation to paying tax of the employee. If the company is unable to, provide those evidences, thinking that it's not your tax, and what's your business? It is not the business of the FRS. By virtue of this provision that allows tax authorities to delegate, these administrative functions to one another. The next is about tax identification. It's now mandatory for tax authorities to issue tax ID to everyone that applies. And upon receiving your request, they have a duty within, I think, about 21 days to issue a tax ID. And I'm sure, I don't even know why this provision is there, because every tax authority is happy to, issue tax identification numbers to everyone. But we'll see a slight tweak in the course of a presentation where without a tax ID, you may not even be able to open a bank account, but we'll get there. So the third on my slide is establishment of the State Internal Revenue Service. So previously, what we had was that every state will try to domesticate the Personal Income Tax Act by having the personal income tax laws of different states. And in the course of, enactment of those laws, we may see the creation of a state internal revenue service or a state board of internal revenue. And usually, most of the state has made it such that the state internal revenue service are part of the civil service of that state. And what that tells us is that those internal revenue service do not have autonomy. And in looking at this issue around autonomy, it was Lagos State that gave the first autonomy to its IRS. And by the time it gave the autonomy to its IRS was the Lagos Internal Revenue Service was able to do a lot of things in relation to that independence, that financial autonomy, that administrative autonomy. They were able to make smart decisions in relation to tax collection, and that drew the tax generated in Lagos State from a low rate to a very, very high rate that we have today. I think the figures are there, and the fact speaks for itself. And as a result of that, other states started giving autonomy to their internal revenue service, Edo did, Ondo did. And the good thing is that when you go to states that their internal revenue service have autonomy, there's always a difference. You see their staff, they look well kept. You see their offices look good. It shows that, see, if we want to really collect tax, then we must make our employees happy. We can't be under the standard civil service system and you want to, see productivity or see optimization of taxes. So the autonomy given to this tax authority gives them the ability to be able to, do wonders in relation to tax administration. And what the provision of this Tax Administration Act has been able to do is to give that autonomy to those internal revenue service by virtue of the legislation. Okay, so I think the next thing I would love to talk about is the requirement now for filing of monthly petroleum royalty. The NTAA now requires companies that are called the exploration and production companies, either having license or leases, are required to file a monthly royalty. I think the government needs money. They can't wait till when at the end of the year when they are doing their annual filings. Okay, so the next thing is mandatory filing of tax incentive returns. And what jumps at me here is that the government is trying to track its tax expenditure. And when I say tax expenditure is the amount of money that a country is giving away to stimulate the economy. And giving away, it might not be giving cash to the system. It may be through tax holiday, through giving allowances, tax credit, and all. So any taxpayer that is enjoying any form of incentive, from the commencement of this act, will be required to file a return to the relevant tax authority, such that those returns can be useful by the state for the purpose of estimating and evaluating government tax expenditure. Okay, so another is where a taxpayer obtains tax advantage. And when we look at tax advantage, you may look at it from the point of view of an arrangement that reduces that increases taxes or reduces relief. It could be an arrangement where an obligation is avoided. And I'll give a typical example. We are aware that taxpayers at times or parties may insert into their contract what we call tax gross-up provisions, such that whoever that is making payments within the phase of the contract will not be required to withhold withholding tax, meaning the counterparty wants to collect its fee net of all taxes. That is a tax advantage. And it's also an avoidance of obligation on the part of the party that is meant to withhold. Now, for the guy that is having a tax advantage, the law requires that disclose this tax advantage. Oh, I entered into a contract, and part of the terms of that contract is that I get my fee net of all taxes. Now, avoidance of an obligation, the party that is also
say that again. Ba da kes kusa-kusa. Wallahi yanzu ka gano can Juma'ar da na je kotu wallahi ta takwas da kan.
Okay, so the other party that is avoiding an obligation to withhold tax also required under the law to make a disclosure. And the essence of this is for the tax authority to track. If you've avoided an obligation, we all know provisions in the law in Total and Akinpelu, and we also know some, or I assume we know some of the introduction by the law that makes it, a non-deductible expense when you bear a tax obligation of the other party. But the tax authority wants to have a full view of the transaction. Okay, you've obligated not to withhold, that's not a problem. You are already penalized because it is not going to be a deductible expense for you. But the guy that has taken the advantage, we also want to know that this money he has received is also net of taxes and will be able to tax it in the hands of that person. So what these provisions will do, but why tax authorities are aware of all this, then the issues around tax gross-up may actually, not serve the purpose that the parties who have introduced it into the contract, will make it serve. So the next one is accreditation of tax agents, and this issue has been an issue for long, and I think it's emanated from the controversies between ICANN and CITN on which is the professional bodies that should regulate the affairs of persons that are engaged in tax consultancy. And as a result of that, over the years, the CITN has tried to develop framework in collaboration with the FRS, such that anyone that will be submitting tax returns for taxpayer must be accredited by CITN. By that time, the members of ICANN felt that they were supreme, and the acts established in ICANN also permits them to practice tax. And as a result of in fact, the tax authorities were not able to enforce this. But I think some of these controversies has been settled, and in fact, it is not the tax authorities that will not be doing this accreditation, and not the relevant professional body, which may settle the dispute. So as at now, commencing January 1st, 2026, all tax agents that will be submitting returns on behalf of taxpayers must be accredited by the relevant tax authority. And it's also important to state that when your returns has been filed by a person that is not accredited, it's deemed that your returns has not been filed. And what does that mean? All the penalties for non-filing of returns will apply to such taxpayers. And I think I just tried to sneak this in. I think I forgot it, so I had to sneak it somewhere in the slide to let us know that when you are a small company, you are exempt from filing VAT returns. And the definition of small company is still not clear. We've seen some certain version of the law that says that small companies are companies that their turnover is less than 100 million. We've also seen some version that says that small companies are companies with turnover of less than 50 million. We do not know. But as it is, let's wait for the signed copy. But it's important to know that small companies are exempted from filing. However, a small company that is exempted may opt out of this exemption to say that, you know what, I want to be filing. And you may begin to wonder, why will a small company that has been given exemption says that, no, I want this body? It could be this. Number one is that the small company may be selling vatable goods, and meaning that in the course of buying those goods, they had paid input VAT. Maybe they imported the good into Nigeria, and at the port of entry, they had paid VAT. Now, when they are selling those goods, ordinarily they are supposed to charge VAT, claim their input VAT, and remit the balance to the relevant tax, to the Nigerian Revenue Service, not relevant tax authority, because it is the Nigerian Revenue Service that collects VAT. Now, if I'm a small company and I'm into this kind of activity, I begin to ask myself, why will I pay input VAT and not file returns? Meaning that the input VAT that I've paid will be with the tax authority. Although there are provisions in this law that says that I can apply for a refund, and the tax authority must pay me within certain dates. But who wants to go through that stress of asking every month the tax authority to give refunds? So it is just, it may just save the headache of such taxpayer or such companies say, you know what, this exemption, I'm out, and you do so by writing to the tax authority. But it's also important to note that as soon as a small company crosses the threshold of not being a small company again, then such company must begin to file its VAT returns. And this takes us to the VAT distribution formula. I don't think this is actually our concern. It's a concern of those in government to know which part of the national cake belongs to them. And this was a very serious issue at the time where the committee, the reforms committee, were trying to get this over the line. And it was really a clog in the wheel of progress. But I think everyone is happy now. The federal government will receive 10%, state 55%, and local government 35%. I think it is one of the concessions that the federal government had to give to say, you know what, my federal will be 50% in the initial bill. So you know what, my 50%, I will give the state 5%. And I think that should solve it. And they were able to convince all the states that, you know what, this thing is not for the purpose of Lagos and Rivers. They may be collecting huge value-added tax, but this value-added tax may not have emanated from their jurisdiction. So meaning you will see a company in Lagos but sells all its goods across the federation, right? And he files all his tax returns in Lagos. Now, the question now is that, are all those taxes, are they from Lagos? Are the consumption in Lagos, because it is on consumption? Are the consumption in Lagos? The answer is no. This company in Lagos would have sold the goods across the federation. And in selling the goods across the federation, the parties that have consumed the goods are in different locations. And, you know, I think they were able to convince the states that, you know what, for the purpose of filing, we've asked the relevant taxpayers to ensure that they state in their returns for the purpose of attributing this VAT to the relevant states, the state in which the consumption of those goods took place, so that the sharing of the VAT collected can be fair and equitable. And I think this is now the agreed, formula for sharing, the VAT collected. 50% of it will be shared in equality, based on equality. That 50% was part of the issue. It used to be 50% for based on consumption, but now I think everyone is happy. So I think we need to move. Okay, so another novel introduction is the electronic fiscal system for VAT collection, and this is not new. You know, the FRS has been trying to introduce this electronic system into the invoicing system of companies for the past 5 to 6 years. The companies have been resisting it, saying that it's an infringement on their piracy, that the revenue authority cannot bring third-party system into their private system. There's going to be breach of confidentiality. There's going to be breach of their trade secrets and all. And that has really created problems over the years. But what the FRS has been able to do, has been able to, sneak this into the law to say, yes, I have the power to introduce an electronic fiscal system to record and report in real time taxable supplies of companies. And in line with this, the FRS recently introduced or commenced implementation of the merchant buyer solution and invoicing system, which requires any company that has a turnover of over 5 billion to, ensure and apply. So it's no longer a question of whether you want or not. It is now required for you to, comply with this fiscalization system of the FRS. And another is simplified tax return for low-income earners. I think that is self-explanatory. Then the next one is advanced ruling. This has also found its way into the law, although under the previous regime or under the current regime, because the law is still in force. We see situations whereby the taxpayer may not be clear with the provisions of laws and may ask the FRS for a ruling that, you can just write on behalf of a client, take some of the services that those that practice tax usually would do, to look at a tricky transaction, and probably the client, you've advised the client and they're not comfortable. We say, you know what, let's get the opinion of the FRS on this. And you write to the FRS, stating your live transaction and asking them, you state your live transaction, you advance the law yourself. It's not like you leave it in their court. You tell them that your understanding is this, and they should kindly confirm your understanding. And they will reply you and, tell you your understanding. We've seen in the past, in fact, it has, been adjudicated by the court, where the FRS had given rulings in the past, advanced ruling in the past, on transaction, and they will make U-turn to say no, they want to change their mind. And it has gone to court. And we've seen it whereby the FRS even went to court to advance the argument that their ruling are only an expression of their opinion and should not be deemed to be the law. And you know what? We tax advisors will say, okay, that's what the FRS is saying. We'll go into our transaction. We may ask them for a ruling, check their ruling, look at the argument of their ruling, vis-a-vis what you've advised your client. If you are convinced that the ruling of the FRS is a selfish ruling or a ruling that does not align with the provision of the law, you can tell your client to continue. But the good thing is that this provision on advanced ruling that used to be a matter of practice is now a provision under the tax laws. And if you look at, I think, Section 78, I'm not very sure now, of this Nigerian Tax Administration Act, gives you broad provision on the workings of this advanced ruling and instances where you may lose whatever ruling that has been given to you. Probably it was obtained by fraud. It did not give the full details of the transaction to the FRS. And I think it's also important to state that as we have it at this moment, I don't know what the FRS will do with this, but I think they will also continue to follow the process. And what they will do is that when you ask for an advanced ruling, they would want to ensure that that taxpayer is a compliance tax. They will ask you for tax clearance certificate for the past 3 years. They will ask you for the tax filing of that company for the last 3 years, just to ensure that the taxpayer that is before them is a compliance client, almost like saying that he who comes to equity must come with clean hands. Okay, so there's also a requirement for persons engaged in banking insurance to ensure that everybody that is their customer, is having a tax ID. Meaning that gone are the days whereby a bank may decide to open a bank account for a person or a corporate entity that does not have a tax ID. So the tax authority is getting close to curbing tax evasion and blocking the leakage of the system. And we are almost getting to a point whereby citizens will no longer be able to negate tax. We are getting very close. So the next on my slide is filing of tax returns, being an employer and employee. This is actually the current provisions under the present dispensation, which requires an employer to file a Form H1 at not later than 31st January of the following year with respect to the income of its employees and the tax paid in the previous year. However, over the years, there's another provision that says that every taxpayer must file the individual return, meaning that if your source of income is just an employment income, you just, go to the LRS e-tax, using the LRS as an example, fill in your profile to say that, oh, my employment income, this is about this, and my employer has paid this, and you will get a tax clearance. But now, the law has made it clear. So it's not a function of, oh, is that what the law is saying? Is that not what the law is saying? It is now clear, in clear terms now, that apart from the fact that your employer has filed your tax returns as part of his own obligation, every taxpayer too, as an employee, if the employment income is your only source of income, just put it in your returns and say revenue for the year 10 million, source employment income X, Y, B legal practitioners, tax paid, you put the tax paid there. Because your employer has inserted your tax ID when you were filing the annual return, the system will automatically recognize that your employer had remitted tax on your behalf, and you will be able to print your tax clearance certificate. And the next thing on my slide is award of contract. I have advanced ruling on it. I think it should be award of contract. So meaning that if you are awarding contracts, you must ensure that the awardee is having a tax ID. When you award contracts to someone without a tax ID, you will pay penalty of 5 million. Imagine you awarding a contract of 500,000 naira to someone without a tax ID, and you are paying a fine or a penalty of 5 million to the tax authority. I'm sure this will be a physical class. I've been hearing some laughter, but it is what it is. So there are some things that I didn't put in my slide, but I just noted them down. And I think there are things around penalty which you'll find in the part 4 or the chapter 4 of this law. And one is that when you change your address, imagine something as minute as change of address, and you fail to inform the tax authority, there's a penalty for it. 100,000 naira for the first month of default and 5,000 naira for subsequent months. So imagine you change your address in January, and by the end of the year, you've not informed the tax authority. You are already owing the tax authority 160,000 naira. If you attempt to bribe a tax official to say, oh, I need a tax clearance, quickly help me get one, and you give them a bribe, it is now spelled out under the law. If you are an individual, you pay a fine of 500,000. For corporate entity, you pay a fine of 2 million, and you also risk imprisonment of not more than 3 years in prison. Now, I know I talked about you being able to apply for tax refund. I know some people are already thinking of how to game the system. Anyway, there is penalty for gaming the system. When you put a false claim for refund of VAT, you pay penalties. 100% of the amount that you've collected, plus interest at the prevailing CBN monetary policy rate. If you falsify document, a lot of companies are guilty of this. They will have account for tax authority, have account for shareholder, have account for management. If you give the tax authority a false account or a doctored account for the purpose of filing your tax returns so as to reduce your tax payable, it is clearly spelled out in the offense. A penalty of 1 million and conviction of no more than 3 years imprisonment. And if there's any offense in this act that no penalty has been clearly spelled out, in such instance, such person will be liable on conviction to 3 years imprisonment or payment or fine of 1 million. I know there are, cross reactions about these new tax reform bills. Some people have applauded, to say that, oh, this is good. It's a step in the right direction. While there are some loopholes that some people will be able to discover. But anyway, the good thing about the tax system or the legal system is the ability for, the subjects over the years or as time goes on, look at those laws and see those ones that require amendment. And I believe that in future times or future years, where we start practicing some of the provision in this law, we begin to see some of the loopholes that may not fit our system. Thank you very, very much for listening.
Okay. That was a very brilliant presentation by Mr. Olamide Obajimi. His lecture is a testament to his the depth of his expertise. Thank you very much, sir. We really enjoyed your presentation. Just to save our time, we're just going to dive right into the next presentation. Mr. Athanasius Akor is a senior associate at GLIS, and he's going to be taking us through the Nigerian Revenue Service Establishment Act and the Joint Revenue Board Establishment Act, which is as I said, Mr. Athanasius Akor is a senior associate at GLIS, a top-rated commercial law firm in Nigeria. His legal practice focuses on tax and commercial dispute resolutions. His tax specialties include general corporate tax, tax controversy, and consumer and industrial markets tax. Mr. Athanasius holds a bachelor's law degree with first-class honors from University of Nigeria. He also obtained his legal practice qualifying certificate with first-class honors as well, double first class, from Nigerian Law School. Mr. Athanasius Akor holds memberships of the MBA, the Chartered Institute of Taxation of Nigeria. He's now set to become an associate chartered accountant with the Institute of Chartered Accountants of Nigeria, having passed his final ICANN professional accounting qualification exam. Athanasius is the president at Emmanuel Yabo Tax Initiative, a virtual training and mentorship platform where he oversees the general administrative functions and activities of EOIT Executive Council. Welcome, Mr. Athanasius. Yes. Welcome. Please, I yield the floor.
Thank you. Thank you very much, Hallelujah. Can you hear me?
Yes,
Can
we
you hear
can.
me?
Yeah, welcome, Mr. Athanasius.
Okay. Thank you very much, Medyoung. I will be, first of all, I just want to appreciate the NBAYLF for inviting me to speak on this topic. And then I just want to also appreciate my seniors and co-speakers, Mr. Olamide Obajimi and Mr. Kelechi Ibe, for doing justice to the two topics. I will just be proceeding to look at the other laws, the Nigerian Revenue Service Establishment Act and the Joint Revenue Board Establishment Act. So, like my earlier speakers have said, I will just
Apologies for that, Mr. Athanasius. I think we've
I will
muted
just
the,
I practice.
yeah, please go ahead. Yeah.
Thank you very much. So I will just look at the new provisions in these new laws, the Nigerian Revenue Service Establishment Act and the Joint Revenue Board Establishment Act, and its effect on our practice and our client engagement going forward. So I will just move into my presentation now because of our time. So I'm going to rush through the slides, and then I'll give us the opportunity to ask our questions. So the Nigerian Revenue Service Establishment Act 2025. Sorry, can you still see my slide?
Yes, we can. Yes, we can.
Okay. Sorry, I'm having an issue. Okay, I think I need to turn off my video. Okay. Sorry, Emejong. I'm just trying to be able to access my slides.
Okay, that's fine. We'll just give you a few minutes to sort it out. So maybe while you're at it, just to note to everyone, joining us via Zoom and on YouTube as well, because we've seen all of the comments requests for the CPD points, and as we had indicated, that will be shared, just before the end of the webinar, just so everyone can access it, and claim their CPD points. So please, you do not have to share your emails or your Supreme Court enrollment numbers for this purpose. So just kindly exercise patience with us till towards the end of the webinar. We will share the link accordingly, just so everyone can access it. Thank you so much. I don't know if
Yes,
Mr.
thank you.
Tinishus
So
is
yeah,
ready.
I'm back now. Can you hear me now?
Yes, I can.
Yes. So I will just be first of all speaking to the Nigerian Revenue Service Establishment Act. As we all know, it repeals the Federal Inland Revenue Services Act 2007. And one of the new things we have seen there is the fact that there is now a new name for FRS. So instead of the Federal Inland Revenue Service, we now have the Nigerian Revenue Service replacing that name, right? So some concerns that may arise in relation to actions that are probably before the court at the moment in the name of FRS, that some actions have been commenced against the FRS, as well as actions that FRS has commenced against other parties, may be a concern in relation to this change of name, right? So I just thought to mention that there is going to be an effect sort of this change of name. In a regular court proceeding where a party's name is changed, for instance, company ABC Limited changes its name to XYZ Limited, one of the things we will see is that the court would mandate parties to amend the relevant processes before the court and to reflect the current name, that's the new name of the party, before the court. So the expectation is going to be that post January 1, 2026, actions or suits before, let's say, the tax appeal tribunal and our courts may need to have the processes amended. But then there is an interesting provision in section 41 F and G of the Nigerian Revenue Services Establishment Act, which seem to take away the requirement for all of this. That is to say that the new name, that is the Nigerian Revenue Service, may not need to or necessarily need to be reflected on court papers by the time you are filing your papers post January 2026 for actions that have already been commenced. So then another concern is in relation to contracts that probably have been executed with the name FRS. The question then is, what is going to be the effect post January 2026? So if you look at the provisions on the screen, paragraph F and G of the section 41, it clearly saves actions that were commenced, number one, in the name of against the FRS, and then also actions that were commenced under the relevant provisions of the repealed laws. So where you have referred to, let's say, a provision of the FRS Act or the provision of CETA, for instance, and post January 2026, we are now looking at the Nigerian Tax Act, the Nigerian Revenue Service Establishment Act. So in that scenario, the requirement is that you may need to amend your papers. But this provision is now saying that where there are legal proceedings, appeals that have been made commenced under the repealed act, those proceedings will continue as if they have been made under the corresponding provisions of this new act. So any relevant provision of the repealed laws that we have made reference to, what this law is saying now is that you not necessarily need to apply for an amendment or amend if you do not want to, right? And then the paragraph G also brings in another novel provision that I think we may also need to take into consideration. I know it is going to be subjected to several interpretations, but it says that where you have maybe enforcement processes or proceedings that you have commenced prior to the commencement of the act, that such act, if it is commenced under the repealed act, we may have to continue and dispose of it under the repealed act. The effect of this clearly is that if I have referred to a relevant provision of, let's say, CGTA, that is Capital Gains Tax Act, in an action that will succeed, let's say, post January 2026, what this law is saying is that I do not need to carry out an amendment. I just need to have it as it is, and the court will have to dispose of it as if that reference is to a corresponding provision of the new act. But then a question that we may, a concern that we may have, which I believe also our clients may raise post January 2026, is what happens where you have a repealed provision of any of the repealed laws that was not maintained by the new laws, and you have commenced an action under that repealed provision. For instance, you have, let's say, Section 4 of CGTA. Let's say that section has now been repealed and deleted under the new tax laws. The question then is, what do you do? Does the action now become an academic exercise post January 2026? But this paragraph G is saying that it does not need to become an academic exercise. It will continue under that repealed act and dispose of under that repealed act. So that is the position on, let's say, processes that you have in court, and then actions that you have commenced under certain provisions of the repealed laws. You do not need to carry out an amendment, but like I would advise, if you can do the amendments, good and fine, you can proceed to amend processes, proceed to reflect the relevant provisions of the new laws. But then this provision saves you that stress. And I think the court also will have to enforce these relevant provisions. You don't need to carry out those amendments, and they can continue under this provision as if they were never repealed. Then I think Mr. Obajimi has spoken to this. This is assistance in tax collection, where you have different states now collaborating with the FIRS to empower, the Nigerian Revenue Service, to empower it to collect taxes on their behalf. So I'm not going to belabor this because he has extensively spoken to it. But just to mention that this also extends to foreign treaty partners. So, for instance, we have a double taxation agreement with several countries. So what this provision says is that Nigeria, the NRS can now enter into such understanding with those foreign treaty partners and collect relevant taxes from their taxpayers that are within the NRS's jurisdiction, that are in Nigeria. So I think that these are actually very novel provisions that we need to always consider in advising our clients. Then moving forward, I know before now, there's always a concern regarding whether some agencies of government are exempted from paying taxes. I know this is not very, very relevant, but I just thought to mention it because I've had friends and colleagues ask questions on this point, whether most of these agencies of government pay tax. So there is not a clear provision in the Nigerian Revenue Service Act that exempts the Nigerian Revenue Service from all taxes. However, it has obligation to deduct and remit taxes, especially, let's say, pay as you earn from its employees, and then agencies that pay as you earn from its employees. Then another relevant provision here, which I also think we need to take into consideration, is the application of the Public Officers Protection Act and other limitation laws. So before now, it used to be against employees and officers of the FIRS. So there is this provision that protects the officials of the FIRS, that if you have to commence an action against them, you need to commence the action within 3 months after the act complained of has occurred and all. But now we now have a new provision that extends it also to the Nigerian Revenue Service, meaning that any action against the Nigerian Revenue Service would have to be commenced within this time limit. So I'm going to speak to this a bit as I proceed, because there are some concerns that we need to actually look at and some sort of contradictions as well. So there is now a requirement of 1 month pre-action notice for commencement of, before you can commence an action against the Nigerian Revenue Service. So before now, all of these provisions used to be in relation to, let's say, employees and other officials of the FRS. But now under this new provision, we now have a provision that says, before you commence an action against the Nigerian Revenue Service, serve them a 1 month pre-action notice. Now, the concern from this stems from the fact that if a taxpayer is to commence an action, for instance, where a taxpayer receives a notice of a refusal to amend or an assessment from the Nigerian Revenue Service, and it's aggrieved, the law provides that the taxpayer should appeal within 30 days of receipt of that notice. But now, what this provision has tried to achieve, or has achieved now, or will be achieving, is the fact that you will have to first of all serve the pre-action notice on the NRS, that's the Nigerian Revenue Service, before you can commence the action. If not, they will have to challenge that action on the ground that it does not comply with the relevant provisions of the law. But then there is a conflict here, and the conflict stems from the fact that if a taxpayer has the obligation to commence an action against an assessment or a notice of refusal to amend from the tax authorities, and then that is to be done within 30 days. But the taxpayer has an obligation an obligation under the law to issue a pre-action notice, which will last for, let's say, 1 month. Some months we have 31 days, some we have 30 days. And the taxpayer cannot file this action until after that 1 month has elapsed. So this brings some sort of, let me say, conflict, because the effect of failure of a taxpayer to file an action, like as we proceed, we'll just see that, right? There is an effect of failure of a taxpayer to challenge an assessment that is made by a tax authority within a period of time. So if we have the requirement of the pre-action notice this way, then what that means is that the taxpayer is always going to be outside of that 30-day period within which it's supposed to, he or she is supposed to file an action against an assessment of the tax authority. Then we'll just speak to this again, maybe as we proceed. But then I think there's also another provision, section 35 that we just mentioned now, seems to be sort of contradiction with paragraph 12 of the second schedule to the Joint Revenue Board Act. Now, what that act says is that's paragraph 12 now, says is that the provisions of the statute of limitation, pre-action notice, or provision of Public Officers Protection Act will not apply to appeals that are before the tax appeal tribunal. The implication of this is that all that I have said in relation to service of pre-action notice, in relation to application of the provisions of POPA, will not have to come in if you are dealing with an action that is coming before the tax appeal tribunal against the NRS. But then the concern with this interpretation is the fact that most of the actions that you have in court today against the tax authorities, they are now coming before the tax appeal tribunal. So if you are saying that this provision does not apply to an action before the tax appeal tribunal, then that means there's a sort of conflict between the two provisions. Because if I am coming before the tax appeal tribunal, there is not a requirement that I should serve pre-action notice. There's not another provision that says pre-action notice will not apply. Don't serve pre-action notice. So just file your action. So there's, like I said, there's a conflict here. And I think it's something that needs to be harmonized so that taxpayers will know whether they can file their action within 30 days or whether they will need to wait until the 1 month pre-action notice period elapses. Then I think I will just proceed to look at the Joint Revenue Board Act. There are some other concerns we may need to address while we proceed, but that will be as we consider this further. So the Joint Revenue Board Act establishes about 3 different bodies. That is the Joint Revenue Board, the Tax Appeal Tribunal, and then the very new one, the Office of the Tax Ombudsman. So before now, at least we always have the Joint Revenue Board, in section 86 of the Personal Income Tax Act. We have the Tax Appeal Tribunal under the FRS Act. But this Office of the Tax Ombudsman is clearly a new establishment, and we will see the functions and what the office is required to do in relation to the protection of the interests of taxpayers. Then we have the objectives of the Act itself. So the Act aims to harmonize and coordinate revenue administration in Nigeria, to provide a mechanism for efficient dispute resolution, and then also the Act also aims to promote the interest of taxpayers. So for the Joint Revenue Board, it has its membership across both the federal and then the state level. So you have the chairman of the NRS as its chairman, then you have all other chairmen of each of the state internal revenue services and the FCT as members, and then you have representatives from relevant MDAs. So one of the key functions of the Joint Revenue Board, which I think it's very important for us to consider, is the function that it has to resolve disputes between tax authorities in relation to determination of residency. Although I know this provision is also in the repealed Act, but some concerns that I have raised from this provision, it's the fact that if there are disputes between two tax authorities, for instance, in relation to residency, you may have to proceed to the Joint Revenue Board to have that dispute resolved. Then, if there is also any dispute at all, apart from this between two tax authorities, they can have the Joint Revenue Board resolve that dispute. But then the question is, what happens to a taxpayer that also probably has maybe has dual residency, maybe live like Mr. Obajimi mentioned, a taxpayer that has lived in Ogun State, also lived in Lagos State, and then you want to assess that taxpayer, and then there is an issue regarding the residency of that taxpayer. That dispute can be brought before the Joint Revenue Board. But then the question is, if a taxpayer has an issue in relation to which of the tax authorities to pay tax to, is it possible that the taxpayer can also come under this provision to ask the Joint Revenue Board to resolve that issue? Now, the law is not really very clear on this, and I think it's a very important provision that should be considered, so that instead of going to waste a lot of resources in court, the taxpayer as well can approach the Joint Revenue Board to say, look, I have two tax authorities with notice of assessment served on me on the same tax. Please resolve this issue. Let me know which of the tax authorities I should pay to. But what we have under the current provision is you have taxpayers that will have to approach the court by way of originating summons to ask the court to interpret the relevant provisions of the law as to which of the agencies or tax authorities it should pay the tax to. So I'm looking at it in terms of the possibility of having the Joint Revenue Board to resolve such issue like this, so that the taxpayer will also not have to incur a lot of cost in approaching a court. So going forward, the Joint Revenue Board also clearly now enjoys exemption from all taxes. But like I said, they have obligation to deduct and remit taxes. Then we look at the Tax Appeal Tribunal, which, like I said, it was in existence under the FRS Act, has now been moved to the Joint Revenue Board Act. So one important point I think I need us to look at here is in relation to the jurisdiction of the Tax Appeal Tribunal. So the Tax Appeal Tribunal now resolves dispute and controversies arising from the Nigerian Tax Act, Act, property where
Okay. I think we've lost Mr. Tenacious. So maybe we can just give him a few seconds to rejoin. So I crave our indulgence to please accommodate him to rejoin and continue. Yeah. Okay, so I just got wind that he has joined back in. So I don't know if the admin team can help unmute Mr. Tenacious. Thank you.
Hello, yes, can you hear me now?
Yeah, loud and clear.
Oh, okay. I'm very, very sorry for the network glitch. So I don't know where you lost me, but I'm on jurisdiction of the tax appeal tribunal.
Yes. It's fine to go on from there.
Oh, okay. Can you see my slides now?
Yes, your slide is visible. Yeah, I can see it.
Oh, okay. Thank you very much. Yes. So I'll just try to speak to some of the issues that have now been resolved under this new law, right? So before now, we used to have a situation whereby some actions cannot actually be clearly brought before the tax appeal tribunal. And the reason is because some laws, especially the Personal Income Tax Act, empowers the state high court, to give orders in relation to some of those grievances. So if you look at Section 104 of the Personal Income Tax Act, we see that there is a provision on notice to distrain there. And the provision on notice to distrain is in relation to where an assessment has become final and conclusive, and a taxpayer has failed to pay those taxes. So the tax authorities can actually proceed to court against the person to get a distrain order and then distrain the asset of that person or that taxpayer. So what we now have under this provision is all of these actions. Hello, can you hear me?
Yes, I can hear you. Please, just give us a few seconds. Let us mute the gentleman whose microphone is on.
Okay.
Okay, I think you can proceed. Yeah.
Okay, thank you. So like I was saying, what we now have under this new provision now is the fact that whichever action you are bringing, the TAT is now sort of the court of first instance. So if it's an action maybe for interpretation of certain provisions of the law, which you have to bring by way of originating summons, the TAT is the court of first instance. If it is in relation to an assessment or a challenge of an assessment, it is still before the TAT. And this action that you are bringing now would all be before the TAT as more like a court of first instance. Now, like I mentioned earlier, appeals, and this is actually in the repealed provision, appeals are to be filed at the TAT within 30 days, and there will be no extension. And if you fail to appeal within this number of days, the assessment by the tax authorities will be assumed to have become final and conclusive. And then you will now be required, to pay the tax, including interest and penalty. So the concern then is, if a taxpayer, for instance, is ready to file the action, but then as Section 35(2) of the Nigerian Revenue Service Act has provided, you may need to give the tax authority, that's the NRS, 1 month pre-action notice. You are ready to file your action, but then you are unable to file because you are still within the pre-action notice period. So there is a conflict here because the taxpayer cannot file, and then if the taxpayer cannot file, then ordinarily the assessment should not become final and conclusive. But what we have here now is, if the taxpayer fails to file within this period of time, because the taxpayer is trying to comply with the pre-action notice period, the assessment will still become final and conclusive, except the court on certain circumstances agrees to extend that period. So this is a concern which I think should be resolved, right? And thank God we have the chairman of the Tax Appeal Tribunal Lagos zone here. So I guess it's something that we may actually have to look at. Then another item which I think is really very important, it's the fact that a taxpayer can now, or let's say the tax authority, depending on who is bringing an action, can bring what is similar to a summary judgment action, sort of, or come under a summary judgment procedure. So what we have here now is a liquidated money claim. So for instance, where an assessment has become final and conclusive, or where a payment is due, sort of a debt is due to a taxpayer or a tax authority. Under the current provision now, the tax authority or the taxpayer can now bring an action under this heading, and it operates generally like a summary judgment procedure, meaning that you can bring the action, file your relevant documents, and then argue before the court that the other party does not have a defense to your claim because you have a liquidated monetary sum as a debt against the person, so against the taxpayer or against the tax authority. In that regard, that action will be placed in the liquidated money claim appeal, and it will be disposed of like a procedure under a summary judgment procedure. But then the concern with this is that this provision is just as it is under the second schedule. There is no additional provision in terms of how this will be dealt with, the procedures for the application, the number of days that the application is supposed to be brought. Like as we all know, under our current regime, for a summary judgment procedure, you have a lot of provisions in the court rules that tell you how to file the action. And also, there is also a requirement that allows a tax payer or the defendant that wants to file a notice of intention to defend. The person can as well file a notice of intention to defend. But this current provision now does not have any additional provision in that regard. So I believe that other maybe rules made by the Tax Appeal Tribunal will really give effect to this. So this also laid credence to what I had mentioned earlier, that you do not need to go to the High Court again to file to recover debt. You can bring that action now before the Tax Appeal Tribunal. And in fact, you can even bring it under the liquidated monetary claim appeal, and it can be determined by the Tax Appeal Tribunal. Another point that I didn't mention is the fact that the tax appeal tribunal now can have an action brought by way of originating summons. So where you have an action that requires the interpretation of maybe certain tax laws, you can now come before the tax appeal tribunal to have those provisions interpreted. I know before now, what we normally do is where you have maybe the provision of a particular law, you will need to have it interpreted by the court. What parties normally do is to approach either the federal high court or the state high court, as the case may be, by way of originating summons to have that interpretation gotten from the court. But now you can bring that before the tax appeal tribunal, and the tax appeal tribunal.
Okay, we've lost you again, Mr. Athanasius. I think Mr. Athanasius has the network issue again. So we'll just give him a few seconds to reconnect back in. Sincere apologies for that.
Hello, can you hear me? Can you hear me, M. Young?
Recording in progress.
Yes, yes, I can hear you, Mr. Mando.
This is Athanasius. Can you hear me?
Oh, okay, Mr. Athanasius. Good to have you
My
back.
apologies. Yes, the network is throwing me out. I'm almost concluding. Okay, so you can hear me now, right?
Yes, I can hear you clearly.
Okay, yeah, so like I said, what the law establishes is the office of the tax ombudsman, and then it has the tax ombudsman as the chief executive officer, right? So now the powers and functions of the office of the tax ombudsman, I've just tried to set out a few of them. The office of the tax ombudsman will now serve as an arbiter, sort of, to review and resolve complaints relating to tax, levies, duties, and regulatory fees and charges. Then it also reviews complaints against tax officials and authorities and seek to resolve them through mediation or conciliation, investigate complaints by taxpayers. So, because of our time, I wouldn't really want to speak so much to this, but I believe that this is a very novel provision, a very good provision in our law, because what we have had over time is a situation where a taxpayer really does not want to go to court. The taxpayer wants an assessment to be concluded within a particular period of time. But because the FRS has, the tax authorities have refused to agree with the taxpayer will now have to go through the rigors of having all of the court processes carried out, trial and judgment, right? But then what they an assessment that you feel that certain provisions, or let's say there are some deductions that were not factored, right? Or incentives that ordinarily were supposed to be factored that were not factored. You can now write or approach. Okay, so I will conclude shortly. So you can now write and approach the tax ombudsman, and then they would intervene on your behalf. In fact, there is a limited period of time now which they are supposed to respond to you, and then also to approach the relevant tax authorities. So they have that power to approach the relevant tax authorities, give their view on that assessment. But then the office of the tax ombudsman, it's not really a court, so to say. So what that means is that they cannot deliver judgment, they cannot give a binding decision sort of against the tax authorities and compel the tax authorities to maybe comply. But what they can do is to ensure that your issues probably are resolved, or to engage the tax authorities and then have some sort of mediation or conciliation proceedings head, just to ensure that the issues are ironed out without you having to proceed to court. And like I said, if they feel that you have a very, very viable claim, they can proceed to court on your behalf against the tax authorities. So just to mention, the Office of the Tax Board does not charge fees. So you can approach them, you can call them, like we've heard in the news, if you are not allowed to call them, email them, you can speak any language to them, right? Provided you have your tax issues that need to be resolved, whatever it is you have, you can always just mention it to them, and they have a particular period of time that they are supposed to respond to you and have the issue at least resolved. But like I said, their decisions are not binding. So to the extent that their decisions are not binding, the only thing they can do is to just try to mediate. But then if you have a tax authority that has refused to comply, for instance, with their directives, which are clearly on the face of the law that they are contravening the provisions of the law, they can as well always write to the National Assembly for the complaint, National Assembly, and then have the National Assembly intervene to exercise its oversight power against the tax authority. Okay, so just like I said earlier, the tax ombudsman does not interpret more like tax legislation to give a judgment on a tax legislation. So the only thing they do, so by the time you reach out to them in that regard, then give an opinion or sort of a recommendation to the tax authorities, which they do not accept. Like I said, they can proceed to court on your behalf, or they can write to the National Assembly in some very, very extreme cases. Then, if your action should not have been commenced in a court of law. So if your action is already before a court and you want to, let's say, withdraw it, or you want to, why the action is in
Okay, I think we've lost Mr. Ako as well. So because of time, right? Because of time, we might not be able to take questions as well. But however, we'll be dropping an email, the YLF official email, on the chat box. So we'll urge that colleagues can share their questions, right? Colleagues can share their questions on the chat box. We'll forward the same to the speakers, which the questions are directed to, and then they'll be able to share their feedback to the respective colleagues who are making the inquiry. So please watch out for the link for the questions, which will be shared on the chat box. Maybe it's also important to note at this point that we've also shared the link for participants who claim their CPD points, right? So kindly check the chat box for the link and claim your CPD points. Thank you so much. So maybe we'll just give just a minute to allow for Mr. Ago to join in. Let's see if he will be able to join back in to conclude. All right. So maybe to also note, the email has been shared by Hallelujah FM on the chat box. The email is mbayylf@gmail.com. So kindly send in your questions to that email. For want of time, we cannot take our questions at today's session. So kindly share your questions to the respective to the particular email shared on the chat box. We're looking forward to it, and we'll provide responses as appropriate. Also, look through the chat box. We've shared it both on YouTube and on Zoom. So kindly check the chat box to claim for the link for your CPD point. Thank you so much.
Please unmute him.
Okay, please. Admin, I don't know if you can help unmute Mr. Ako. I think he's back.
Emelion, can you hear me?
Yes, I can hear you now. Okay, I think we've lost you again. Apologies, everyone. I think the connectivity has really been a difficult issue these days. I must sincerely apologize for that. We'll still give him again a minute to just see if he can quickly join in and then give his closing words. Because I know we are really out of time for this event. We had a hard stop of 5, but we had to extend it for 43 minutes because we started a bit late. So please allow for just a minute to see if Mr. Ako can join in to conclude on his presentation. For questions, because we've had a couple of questions on the chat box, but we are unable to take it at this time. But please kindly share those questions to us via the email shared by Hallelujah. Right. Once we receive it, we would forward it to the respective speakers, and I would also share the responses back to you as well by return email. Thank you so much for your patience. We've really had people join us across different states. We're really appreciative of that. Just to note, we've had about almost 1,000 join us on YouTube. And again, we had a maximum capacity of 500, which was, it's full. So really appreciate all our audience and participants, colleagues who joined in. We're really excited for that. I think we are unable to get Mr. Ako back in. But I mean, please kindly check if it's
Emelion, can you hear me? I'm here. Can you hear me?
Yo, super.
Oh
Yes,
yeah.
super.
So I'm
yes, I
actually
can hear
on
you.
I'm actually on the last slide. Can you hear me? Hello, can you hear me?
Yes, we can hear you.
Oh, okay.
Yes,
Yeah. So I'm
yes, I
actually
can hear you.
I'm actually on the last slide. So I was
Please
just
go
trying
ahead.
to
Yeah.
I was just trying to speak to the limitations, to the powers of the functions of the tax ombudsman. So I had mentioned that they do not give judgment and they do not issue a binding order against the tax authorities, and they do not determine issues that are already before the court of law. So before you approach the tax ombudsman, just make sure that your action is already not before the court, and then also they do not issue assessment. So all they do is to assist you to carry out some sort of engagement with the relevant tax authorities. Yes, so I think at this point, because of my network, I will just stop. So I've just been able to go through my slides. So I'll just stop here and then maybe we can just get questions. So thank you very much.
All right, thank you so much, Mr. Athanasius. Thank you so much for your time. It's been very an excellent session. Maybe just to tell all our participants, we'll be sharing the slides via email to everyone who attended the event. I'm sure please kindly mute as we wrap up. Thank you. Yes, thank you. All right, so we've shared the link to on the chat box for everyone to claim their CPD point. This is just to acknowledge your participation at today's event. We're really excited that you were able to join in despite your busy schedule. And I'm sure all our speakers we're also excited to share their respective updates in relation to the new tax reforms in the country that will be taking effect in 2026. So thank you again to all our speakers, Mr. Athanasius, Mr. Ibe, and our partner who joined in from Lani Unajai. Thank you so much for joining in. We're really grateful for your time. Thank you so much. Thank you very much. So I don't know if the CLE chairman, the CLE YLF chair is here, or if the CLE if the YLF chair is also here, they can quickly just give a few remarks before we close.
Okay, thank you very much, Emediong. Thank you to our very brilliant speakers and all their contributions and their teachings and their lectures. Thank you so much for the participants for joining our webinar. I'm very sure the sessions are very enlightening and educative. We hope to see you at our next one. Thank you very much. And we apologize again for the logistics issue. I'm very sure with time we'll get better at it. Thank you. All your inquiries, including how to join the MBA YLF, we're happy to answer. You want to get slides, you have questions for the speakers, please direct your inquiries and questions to the email in the chat box as mbayylfcle@gmail.com. Thank you very much, everyone. Thank you very much. Have a lovely evening.
All right, thank you. Goodbye, everyone.